If you are self-employed or receive rental income, your tax reporting obligations are about to change permanently. From April 2026, many individuals will no longer file just one tax return per year. Instead, you will report to HMRC every quarter. This is not a proposal, it is not a consultation, it is legislated, and it will apply to a far broader group of people than many currently expect. For decades, the annual self-assessment return has been the foundation of personal tax compliance. You kept your records during the year, you filed once, and you paid based on the year-end position. That model is now being replaced with a system of continuous digital reporting. I'm Jamal Khan, Senior Tax Partner at Churchill Tax. Today, I want to provide not just a technical explanation, but a strategic briefing on what this change really means. We will cover who is affected, how the system will work, the risks and opportunities it creates, and what you should be doing now. Because those who prepare early will experience control, while those who delay experience pressure. The direction of travel in UK taxation, before we look at the detail, it is important to understand why this is happening. The UK tax system is moving decisively towards digital integration and real-time data oversight. This is not a short-term policy shift. It is a long-term transformation. This change is being driven by HMRC. Making Tax Digital, or MTD, is HMRC's strategic program to modernize tax administration, reduce human error, and close what it describes as the tax gap. HMRC estimates that billions of pounds are lost each year through inaccurate record keeping and careless errors rather than deliberate non-compliance. Its position is that digital records maintained in real time and submitted more frequently will improve accuracy and reduce that gap. We have already seen this introduced for VAT. Many businesses initially resisted the change, yet over time it became embedded into the normal practice. Income tax is now the next phase, and because it directly affects individuals, the impact is more personal and more visible. This reform is part of a wider trend toward data transparency. HMRC is increasingly able to cross-reference information from banks, land registries, employers, and digital platforms. Making Tax Digital fits into that broader ecosystem of connected information. The key message is simple. The direction of travel is digital, and it's not reversing. From April 2026, MTD for income tax becomes mandatory for self-employed individuals and landlords with annual gross income exceeding £50,000. From April 27, that threshold reduces to £30,000, and it is expected that over time it may reduce further. The most important word in that sentence is gross. This is not a profit test. It does not matter what you take home after expenses. It is your total turnover that determines whether you fall within scope. If your business generates £55,000 of income but produces £20,000 of profit, you are still required to comply. If you have £35,000 of consultancy income and £20,000 of rental income, those figures are combined. This means many individuals who consider themselves modest operators will find themselves within the regime. It is also important to understand that once you enter the regime, you remain within it until your income falls below the threshold for a sustained period. This is not a year-by-year election. It is a structural shift in reporting obligations. In practical terms, if your income is approaching £50,000 now, you should be already planning for this transition. Under the current self-assessment system, you maintain records throughout the year and file one return after the year end. Tax is generally paid in January and July, and there is a single primary reporting deadline that drives compliance behavior. Under MTD, that model changes fundamentally. You will be required to maintain digital records throughout the year using HMRC compatible software, and you will submit 4 quarterly returns summarizing your income and expenses. At the end of the tax year, you will submit an end-of-period statement to finalize your business figures, followed by a final declaration confirming your overall tax position. In effect, you move from 1 tax return per year to at least 5. The quarterly updates are not full tax returns, but they create a continuous digital footprint of your financial activity. This means record keeping can no longer be retrospective or disorganized. Discipline becomes central. Income must be recorded promptly, expenses must be categorized correctly, and data must flow through compatible software without manual breaks in the digital link. Paper records will not suffice, and spreadsheets are only acceptable if integrated through approved bridging software. The transition is less about technology and more about consistency and routine. This change also introduces more deadlines, which in turn introduces more exposure to penalties. HMRC's point-based penalty system means that repeated late submissions will accumulate consequences. More frequent reporting also means more frequent visibility. Variations between quarters, anomalies in expenses ratio, or inconsistent patterns may become apparent sooner. However, there is a positive dimension. Regular digital record keeping provides greater financial awareness. It allows you to monitor performance, plan for tax liabilities, and make informed decisions throughout the year rather than a year at the end. If you're approaching the £50,000 threshold, the time for passive observation has passed. You should review your current income levels and forecast whether you will fall within the scope in 2026 or 2027. You should assess your existing record-keeping processes. Are they digital, structured, and consistent, or are they reactive and year-end driven? You should identify whether your current software is compatible with MTD requirements, and if not, plan a transition. Implementing new systems takes time, and habit formation takes even longer. This is also a moment for strategic review. Does your current business structure remain appropriate? Should incorporation be considered? Should property holding or trading activities be reorganized? These are not universal solutions, but a reform of this scale warrants strategic conversation rather than simple compliance. April 2026 may appear distant, but in practical terms it is not. Systems require implementation, staff or family members may require training, and routine requires development. At Churchill Tax, we are already working with numerous clients to ensure the transition is done smoothly, with structure and confidence rather than last-minute pressure. Making tax digital for income tax is not a minor administrative update. It is a structural shift in how individuals interact with the tax system. Preparation creates control. Delay creates risk. If you would like clarity on how this reform affects you, we would love to help you. Click on the link below to book a call with our team.